So good afternoon, everyone. My name is Rose Easton, and I'm Chief Responsible Investment Ecosystems Officer for the PRI, with responsibility for UK, Europe, India, Middle East, and Africa. And I'm obviously your moderator for today's session. So the purpose of this afternoon's panel is really to give you all a practitioner's view on how responsible investing can really help in the generation of alpha from across a number of different ways in which you can invest money, so different styles, different philosophies, both from an integration in the investment process point of view and also from a portfolio construction point of view. So on that note, great to introduce the panel that we've got today. I'm really delighted to be joined by Arup Datta, who is Senior Vice President and Head of Global Quantitative Equity at Mackenzie Investments. So Arup's going to be bringing the quant view to our discussion this afternoon. Thank you, Arup, for joining us.
Happy to be here.
Next Arup is Rob. Rob is Chief Investment Officer for Responsible Investment and Chair of the Responsible Investment Committee for Man Group. So Man Group, as I'm sure you're aware, is a highly active, really data-driven investment manager using both quant and fundamental processes. And of course, they manage both long and short strategies. So thank you, Rob.
Great. Thanks, Rose.
Then we are joined by Anna. Welcome, Anna. Anna Murray is Senior Managing Director of Total Fund Management and Global Head of Sustainable Investing at Ontario Teachers Pension Plan. So Anna's bringing the asset owner perspective to our panel. Laura, welcome. Laura Nishikawa is Managing Director of ESG Research at MSCI. So we have some research and data expertise core to this question today. And finally, we're joined by Bonnie Wongtrakool, who is Global Head of ESG Investing and Portfolio Manager at Western Asset Managers. So managing both fixed income assets as well as multi-asset portfolios. All right, so there's a real interesting or increasing sort of body of evidence to say that there is a strong correlation between ESG rankings and risk-adjusted returns. And during this session, we're going to explore a number of different aspects around this. So after we're going to hear from each of the panelists very briefly in a second to give you a little bit of some opening remarks, to give you a bit more context as to where they're coming from. We're then going to explore a number of different topics. We're going to think about, is ESG actually a factor by itself? We're then going to look at how some of the recent trends in performance has actually impacted the attribution that you can get from sustainability and challenge that. And then we're going to think about what are the sorts of questions and conversations we should be having in a couple of different levels. One is, how do you have these conversations around this relationship externally with your clients? And how do you have this conversation internally, if you're a portfolio manager, with your CIO and others to sort of gain advocacy? We're going to look at the roles of rankings and research in supporting sustainable investing. And then we're going to finish on basically what this session sort of says on the tin, which is how do you, their best ideas, when we're canvassing everyone for their best ideas on generating alpha from sustainable investing. So that's our plan. And we'll also, obviously, please go ahead, ask questions in the app that you can do. We'll try and take as many of those as we can at the end. We'll try and make sure we allow some time. We've got quite a lot to get through, so I've asked my panelists to be quite disciplined in some short and punchy answers to get through the what is quite a complex set of questions today. So as I say, if I can ask each panelist just to start with just giving that a little bit of a 1 minute sort of remark on your own organization's perspective on that relationship between ESG factors and returns. So Arup, I can start with you.
So my pleasure again being in Toronto. As you know, Mackenzie is sponsoring this event. So obviously that speaks to how highly Mackenzie thinks of ESG and its applicability to investing. As for myself, I'm a generalist. I lead up the quant equity effort out of Boston in the US. I've been doing quant equity now for 32 years. Happy to be with this gentleman to my right. We worked together for half of that time before. But I come from a generalist perspective, and not to steal my thunder from the later, but I'll just say that we have ESG as one of our process in terms of stock picking, and it has added alpha for us since we have been using ESG many years back.
Thank you. Rob.
Great. So Rob Furdak, again, I'm super happy to be here in Canada. I love Canada, big hockey fan, so great to be in the home of hockey. As Rose mentioned, Man manages a diverse set of strategies, equity, credit, commodities, and we try to integrate ESG. Part of my role is to figure out how to best integrate ESG into those different strategies. And I think for us, it's really focusing on materiality. And the materiality depends both on the type of strategy, what kind of investment philosophy it's pursuing. Is it fundamental? Is it growth? Is it credit, defensive? And what's material depends on both the asset class and the investment discipline. So that's kind of a key thing. Some of our other tenets are, we think, we're big believers in integration rather than exclusions. We're big believers in ESG as a factor, not the factor. We think it should be used alongside other material factors. And we also believe in engagement. We think engagement is a good way to try to affect change, is probably the best way to affect change in investment portfolios. So I'll leave it at that.
Lovely.
Turn it over
Thank
to
you,
Anna.
Laura.
Thanks, Rob. And so nice to see so many familiar faces here today. So thanks very much for having me. So I work for Ontario Teachers Pension Fund. We have about 250 billion of global investments on behalf of 330,000 individuals. So our mission is quite focused. ESG is obviously forefront to what we do. We're not your typical pension fund in that approximately 60% of our assets are actually direct investments in privates. So that gives us a pretty strong ability to engage with and work in partnership with our portfolio companies.
Fantastic.
I am Laura. I head of research at MSCI, and I'm not going to introduce MSCI to you, but I was going to answer this question by saying 5 things that we offer to the table. Our job isn't to generate alpha, it's to help everyone in this room generate alpha and manage risk and returns from their investments. First, research. So my colleagues and I published a paper in 2017 called The Foundations of ESG Investing that put forward a framework, a both conceptual and empirical framework for evaluating ESG and returns, and we continue to update that. Secondly, indexes. We have over 1,000 fixed income and equity indexes, which are essentially portfolio implementations of different ESG strategies, so you can see how those historically have performed. Thirdly, factor models. So we incorporate ESG into our factor models so we can attribute how much of those returns are ESG specific or related to other stylistic or industry factors. Fourth is our ESG ratings and data. So we have the longest history of and most consistent framework and tested framework of ESG rankings going back 17 years. And that's 17 years of live history, not recast, not backcast, not restated. That has been the most heavily used and tested by academics. And then speaking of academics, our 5th item is our Sustainability Institute, which my colleague Linda Illing-Lee launched last year, which is essentially collaborating with academics to put all of this data, all these tools in the hands of academia to help understand and unpack these questions.
Great. And Bonnie.
Thank you. So first of all, thanks to the PRI for having me, and thanks to everyone in the audience for coming to the panel today. So for those of you that are not familiar with Western Asset, it is a fixed income specialist. We have about 380 billion in AUM across the globe. We have 9 offices around the world, and we are a subsidiary of Franklin Templeton, which is about 1.7 trillion under management as well. So we have assets across all asset classes that Franklin Templeton manages. And we are an active fundamental value manager. So our approach to ESG is really about integration. And similar to some that have spoken, like Rob, for us, ESG is very, very important to identify intrinsic value, but it doesn't necessarily preclude us from investing, nor does it necessarily drive our investment decision. So integration is something we do apply through all our portfolios, but we can definitely dial it up for the clients that want to have more of an emphasis. And our research is done by our sector specialists. We don't have a siloed research and engagement team. We really feel that for integration, it's very important that the sector experts do the analysis because they can identify what is most financially material. And that's really at the heart of what we do.
Super. So hopefully that's given you all a bit of a context to the questions as we go through these and how you'll get these answers. So I'm going to move us on to our first topic, which I guess is probably one of the most important ones, which is ESG actually a factor? And Robbie almost, answered it in itself, saying it's a factor, but not the factor. But I'm going to turn, I think, to the quant in the room, the pure quant in the room to start us off, given this feels like it's a bit of a quant factor. So is it actually a factor? Or do we, is it just an indicator of maybe quality? Or is it just some sort of amalgam of a whole set of different common risk factors?
I would say it's a lot of both, and ESG for a quant like me is actually a debated topic. I have heard many of our quant competition speak about ESG not being an alpha factor, being a risk factor, or something else. I myself come out very much on the area. As I mentioned earlier, we have been using ESG as part of our stock selection model for about last many years, and it has added to our alpha process. So I'm a big believer that ESG is one of the factors you need to look at when you pick stocks. We also have a very proud build here mentality. Everything we do is ourselves. Yes, we rely on folks like MSCI, Sustainalytics, and others for the underlying data. But then we build our own ESG metrics for the 20,000 stocks we cover throughout the world. That's a key quant benefit. You can cover 20,000 stocks throughout the world and rank every stock on ESG on a daily basis. So we play to our strength of quant. We rely on SASB metrics, all the good data providers, put it all together. Being a good quant manager, you're very good about backtesting in the past, so we know how to do all that. And so we found when we put it live in our process 4 or 5 years back, that it made sense to come in. When quants look at research, they see by adding this new idea, does it add to your current existing mix? And we found it added to our mix every region of the world, China at one end to US large cap, US small cap at the other end. So that's why we introduced ESG as one of our factors. I'm an old school quant. I like to put things into the value, growth, quality bucket. We put this into the quality bucket.
Okay.
Because we think all else being the same, ESG is about the quality of management, how they're doing ESG practices. I would say one more thing. Obviously, there's a lot of data here. So if you're a good quant manager, you have to be very careful about data mining the past, et cetera, et cetera. So you have to put some additional effort here in terms of building this factor. So for us, hopefully numbers speak for themselves. So I'll end by my first statement, which is to us, ESG is an alpha factor. It has added alpha everywhere. And one last thing. ESG is the one area where we redo research every couple of years. Because unlike other factors, if you build a long-term growth factor, you don't need to redo the research every 2 years. ESG is a growing field of new data and better data coming out. So we made a decision when we first launched our ESG version 1 model that every 2 years with added data, we'll revisit ESG. So we're now on our version 2, soon going on version 3.
Fantastic. Okay, so Rob, if I can ask you the next one, can the individual sort of E, S, and G be kind of disaggregated? And I know Man Group's done some work around the social factor in itself, so I'd love to hear a little bit about that, and then also maybe some thoughts around, is it just that correlation, or can it be sort of Is there a proper causality that can be identified, or is it pure correlation? So perhaps taking sort of both of those.
Sure. Yeah. I think that we try to separate E, S, and G and even get further below, because S is a very complex thing. It's employees, it's products, it's the community. So breaking down even the E, S, and G down into different factors is something that we think is really important. And again, as I mentioned before, it's about financial materiality. So figuring out, what's material for a bank is different than what's material for a mining company or a tech company. So those factors are both different based on the industry, or even like within tech. Intel makes chips. Water sensitivity is a big issue for them. NVIDIA doesn't make chips. They don't really care, even though they're in the same sector. Yeah. So it's not just, it's not just the headline. Let's look at it from an industry perspective. It's really kind of going one layer deep. And I think I think there's this talk about ESG being this monolithic, item of, it's got to all be together. But again, I think you really have to look at the materiality of how it impacts different components, and we think that it's going to be additive on a risk-adjusted basis going forward. And part of that comes from risk reduction, and part of that comes from the return or the opportunity set. So being able to make that distinction is also really important. And also trying to have a view towards the future, not just in trying to use forward-looking data where you can, but also realize that, if you run a back test over the last 10 or 20 years, the world is different. The world's going to be very different in the next 10 or 20 years. So trying to, both in terms of how companies manage themselves, how do they care about environmental factors or social factors, and how that's going to look going forward. So as we're seeing now, extreme weather is becoming a big issue. So it's going to probably play a bigger role going forward. So
yeah, that's really interesting. Bonnie, from I guess maybe multi-asset perspective, we heard Arup saying that actually he's seen this across the geographies. Do you see this playing out within across the different asset classes and across all of the different asset classes? And also, your view around the geographies as well.
Yeah, I think we should take a step back just for a second and just ask ourselves, why are we always revisiting this question? We were talking before the panel, just chatting up here about this question is always being asked. Is ESG a factor? Can we identify it? Can we separate it? And I think there are a couple of reasons why people get, a little bit confused and the information out there can be very misleading. I think one is that there is this correlation with quality. So it is hard to disaggregate that. Certainly within fixed income, there's a huge correlation with credit quality. Companies that are more developed, they have access to the capital markets. They have the luxury of being able to think into the future, think longer term, have sustainability plans. So they're more likely to have better ESG qualities, and so are sovereigns. And that's one of the reasons at Western that we actually have a sovereign framework that adjusts for GDP per capita, because we don't want to penalize developing economies for just being, earlier on the curve. The other reason I think was mentioned already is that people are looking at ESG factors as one big monolith, and they're often looking at top level ratings. I think by asset class, you need to identify what are those financially material factors that actually could drive performance. And that's what we tried to do at Western. We actually did an internal analysis with machine learning where for industrials and energy, we looked at those two sectors, we identified what we thought could be potentially financial material, and we actually use those factors in addition with traditional financial metrics like leverage, interest rate coverage, and stuff like that. And what we found was that most of the bond spread performance was actually driven by the traditional financial metrics. But there was some positive statistically significant effect of these ESG factors, and they were particular to the sector. So you really do need to dig into that. And one other note I wanted to make about this is people often sort of write off the S, the social. And when you look at the ratings agencies, I think all of them have now articulated both E, S, and G as distinct factors and explained how they think about those when they think of their ratings. And to give you an example, for Moody's, they looked back over the past year at their ratings changes, their ratings actions. And most of those where ESG was involved, so about a quarter of their ratings actions had some key driver was E, S, and or G. And most of those, 93%, was governance, no surprise. But actually 60% was social, which I think initially might be surprising, but when you think about it, it is so pertinent to some of these sectors, pharmaceuticals, metals and mining. It can really make or break and result in very high liabilities. So we were starting to see, this data emerge and this understanding that it is a financially material factor dependent on the asset class. You have to be very thoughtful about what you're considering as a driver.
Yeah. So we're hearing there's a real specificity, if I can say that, between sectors is really important in terms of materiality, geography to an extent, and asset class.
Can I just ask one quick just shout out to MSCI? I think one of the big benefits of MSCI coming up with their carbon efficiency and ESG scores, you can take a look, if you have your own ESG model, you can see how does it do over and above the MSCI model. It just becomes a good benchmark. So I think that was a great addition.
So that's a great lead into Laura. I'd love. I was about to lead you on the data point, but let's go there.
Let's go, and I love that because that's what we're trying to do here. I encourage everyone in this room to beat our ratings and beat our indexes. That's the whole point. But yeah, a couple points, and I think you all brought up some interesting ones. So we published a study in 2017. We had a bunch of follow-ups, passive implementations, active, equity, fixed income, and then we kind of thought our job here was done, and obviously it's not because the question keeps coming back. So this year we updated all that research. And I think with the backlash we're seeing in the US, with the shift to kind of double materiality in Europe, it was really important in 2024 to go back to basics and remember why we're doing this and how has that evolved. So a couple things that I'll just point out about our research. First of all, the relationships between ESG and performance still hold. We look at three categories of things. We look at firm performance, so profitability, earnings growth, fundamental factors. We look at company-specific risk, so events, drawdowns, residual volatility, and then we look at how that's valued by markets. And particularly on the first two, we see that relationship has even strengthened. So ESG factors and the E and the S and the G, and I'll get into the pillars, have an even stronger relationship with the fundamentals of companies across geographies, across sectors. How that's rewarded by markets is a little bit different depending on when you're looking, what time horizon, where. But generally and by and large, it still holds. It's just a bit more complicated. We also look at the E and the S and the G pillars. So first of all, we still continue to find, and we did a paper in, I think, 2019 called Decomposing ESG or Deconstructing ESG, and we looked at the pillars versus the aggregate signal. We do still find more explanatory power in the aggregate signal than in any of the individual factors. And I think part of that is because of the sector materiality. The way that you combine these factors and weight them for a given sector is important. But that said, we see more and more of our clients trying to get deeper, get more specific, and really tailor their strategies. So we've done a lot of research, and if you, I'm going to give you some tidbits and findings, but if you want to learn more, there's podcasts, blogs, and papers, depending on your level of attention span. So going to ES and G, I love that both of you brought up S, because I feel like S is the ignored middle sibling of the other two. You know, you have the big sibling governance that's older and knows everything, and the attention hog of environment, but social gets overlooked.
Middle child.
And we found across regions, across sectors, that S has been the most consistent performer of our pillars. And that was surprising. And the first thing I thought when I looked at that is like, okay, well, maybe we have good S ratings on NVIDIA and Apple, and that's fine. But it actually goes across sectors when you control for size and so forth. So that's really interesting. I think something also that's very important there is which of the S factors matter. So for us, the ones that matter the most are ones related to human capital, ones related to community relations, and factors related to product safety, unsurprisingly. And these are just basic things that maybe the media doesn't pick up on. When they think of S, they think of maybe one thing, which is DEI. There's actually a lot more there when you're thinking about Boeing or companies that are having major crises over safety. These are just basic, fundamental parts of running a business, but those are material. The one pillar or theme within our rating that underperformed was the more impact-oriented theme, which is social opportunities, access to finance, access to health care. That was either neutral or non-existent. Governance, of course, is steady, but it's uneven between different regions. And I think that governance is so driven by the market that you're in, and that's really important. So, for example, if you just did a top quartile, bottom quartile, or long-short governance strategy globally, you would miss the improving governance in Japan that has been a big part of the Japanese equities story. They still, we've seen big improvements in corporate governance in Japanese companies. We think that is very related to the growth and the performance there, but they still are laggards relative to the globe. And so you really have to think in a nuanced way. Our governance scores also, we see significant outperformance of governance leaders in the US, but not in markets like the UK, which are much more homogeneous, where there's not as much daylight between a governance leader and a governance laggard. Yeah. And then finally on environment, it's actually the hardest to look at historically. I'm curious what you guys think. I think partly because a lot of the environmental themes that we're looking at haven't yet materialized. We're talking about prospective issues around carbon pricing or pricing in natural resources. But something that we found very recently that I thought was very interesting is that If you take a risk management approach to climate change, so our climate risk scores that look at how different companies and different sectors are managing climate-related risks, that was pretty flat until 2020 and has been increasingly yielding out performance since 2020, which is what you'd expect. But climate opportunities, so renewable and some of the sector bets there, that can be very, very noisy based on valuations.
And I think actually that's a nice segue into our sort of second question around, I guess, the sort of, and Bonnie, your point earlier on, why are we still talking about this? Well, maybe we're starting to talk about it again because the elephant in the room is we've had 2 years of pretty tricky performance for some funds which are sustainably invested. You've obviously had, there was a very strong, I think, signal up until 2022 really showing this sort of very, very strong correlation between the two, between the performance and ESG strategies. But since the Ukraine crisis, I think this changed the narrative a little bit. We obviously saw a huge rising oil prices, those stocks rallying massively, defense stocks rallying massively. And of course, so many sustainability funds just didn't hold those, and it really impacted performance. And I think that's probably shaken investors a little bit. So I think sort of with that in mind, I'd be really keen to hear some of your views around how that period has kind of impacted some of these correlations and some of these views. And I think maybe Anna, as the asset owner in the room, it will be good to start with you on this. What is your view on what's happened to funds and the benchmarks over the last couple of years? How's that changed the conversation you've had with managers who are invested in this way? And I would also love to know, is this a short-term blip? And can you take that longer-term view and look through this to trust your managers and see through the noise? So, yeah.
Yeah, thanks for that. And I might bring, or at least try to bring, two different perspectives. This one, it's in terms of being a long-term investor, right? So for us, it's not necessarily focused on the short term here. These are long-term relationships, long-term investments where we are very much focused on, what the process is. So how has the last 2 years impacted our approach? If nothing else, we are more engaged, more involved, and have further work with our managers. The other piece that I would bring is what I mentioned before, is in terms of our direct investments on the private side. We have seen an absolute flourishing with the amount of work that we are doing with our portfolio companies. And I know that some of my colleagues are in the room today. So I think it's likely important to note is we are very much focused on the signal and not the noise. We understand the work that needs to be done across the board in terms of E, S, and G, not just from this risk mitigation lens, but very much now from the opportunity and value creation perspective in asset management. So not just at the due diligence side of things, but across the asset life cycle. And we're seeing a lot of engagement and good work that's being done. One sort of case in point example is with our Paris-aligned reduction target program, our PART program. And we've already been able to work with 29 of our companies to work on their decarbonization strategies. And this work has grown into the rest of their sustainability strategies as well, because they're starting to see quite a bit of improvements and value creation that's happening there. So in short, the financial performance of the last 2 years has done nothing but help us really focus on what's material, what's valuable, and helped us really focus on being sort of that trusted point of contact in working with our investment teams.
Yeah, that's number one. That's so encouraging to hear. Research plays a really key part in this, Laura. I think to help in this process of really understanding things. It would be great to hear from you in terms of what this has done from a research perspective.
Yeah, I'd love to hear the others as well. I really liked your point about ESG is one factor and not the factor. I think that when you see the headlines, it's as though we said, okay, look at ESG and forget about geopolitics, forget about interest rates, forget about everything you knew, and just look at ESG. And I don't think that's what anyone in this room or anyone on this stage is trying to do. So obviously there are other factors. I think we've continued to see the same thing that we've said since the beginning, which is that leaders within a sector tend to outperform laggards in a sector. I have to say in the energy sector, it's been a little upside down sometimes. But what we've seen mostly is that where there have been ESG strategies that are really focused on the kind of specific aspects of ESG performance, so leaders versus laggards, those continue to track relatively closely to their benchmark and maybe show some outperformance, and maybe some of that is attributable to an ESG factor. Where we see a lot of underperformance is because there are very big sector bets mostly, or very big regional bets. So something that I'm a little bit worried about is as the conversation and you see the evolution of ESG has moved from really integration focused to having also other objectives. And some of those objectives really are pushing very hard for divestment and divestment from certain sectors, which could be perfectly appropriate based on your goals. It's a different thing, right? So yes. I think we need to really understand the impact that divestment has or the impact that exclusions have separately from integration and be able to track and communicate those separately.
That's a really good point. Yes, the whole divestment engagement debate, which is probably another panel in itself. So I'm probably not going to go there right now. Arup, I'd love a view from a quantitative perspective. And has this sort of shifted in terms of any of the sort of, have we seen evidence in changing like sector weightings or the way in which any other sort of portfolio construction, universe selection, that sort of thing? What's the quant?
Yeah. Firstly, I sort of back up what Laura said. I think whether ESG has worked or not is not just by looking at ESG strategies, because those have huge sectoral biases. They're long technology and underweight or not in energy at all. As a long-term quant, I'm always looking within the peer category has ESG worked. So within energy has ESG worked, comparing peers to each other within technology. And as I said in my initial introduction to myself, since we have been using ESG, including the last 2 years, ESG has added to our process, looked at it our way, which is peer relative. Are you doing better in terms of your ESG practices? And has that been rewarded in the marketplace? And that continues to be the case, whereas, as you mentioned, the Ukraine war and all has had more sectoral swings. But I've always been a micro stock picking person. So we don't, we have never made money by timing sectors or timing countries. So I would say the way we look at ESG continues to work as it did in the past, I would say, and I don't see why that should stop working. And just one more thing, if I may add to what Anna was saying, I'm also fortunate to be in a firm like Mackenzie where I get to do my stuff, which is investing. But there's a whole entire separate team which is doing the engagement, the proxy voting for us. They do their strength area, we do our strength area, and hopefully the clients are better off with the combined effort.
Excellent. Rob, I mean, are you sort of jumping at the bit here from a quant perspective?
Yeah,
yes,
I'll
exactly.
put my quant hat. But I think the last couple of years is a kind of testament that you have to look at the interaction between these factors. And if you look at, say, the clean energy sector, when we started off kind of 18 months ago, they were darlings. There were big flows going into that. So there was a flow story. There was also a valuation story. Yeah, these stocks had a great ESG profile, but they were very overvalued, and they had unsustainable momentum. They're very interest rate sensitive sector. If you want to buy an EV or put some solar panels on, whether you're a consumer or a corporation, you generally have to borrow some money. So interest rates go up, valuations are high, momentum is unsustainable. There are a lot of headwinds that people should have been paying attention to, and so just putting that into perspective is an important part of the story. So
there was a bit of a bubble, wasn't there, waiting to burst, as always.
Yes.
Us investors love this, don't we? We always pile in and then get surprised when it bursts.
And I think just last year was interesting because we have a separate suite of climate models where we're looking at things like physical risk and transition risk, and those actually performed quite well. Because they're really measuring something different than the traditional E, in an ESG factor, where it's really based more on the climate science and other things and how companies are sensitive to extreme weather and other events. So
okay. So let's move on to sort of our next which Anna, we were starting to touch a little bit if we think about the client conversation. So and the conversation you'll have your investment managers and the other way around. When you do get these bumps in the road, as you were insinuating earlier, you actually just engage even further with your managers. What else do you need to see? What sorts of maybe reporting or evidence to really give you that sort of confidence you need to just keep pushing forward, knowing this is still the right thing to do as an asset owner?
Right. And in terms of our engagement with the CIO office, I would say two things. So one, and what we're hearing on the panel today, is really about this focus on materiality. So the sustainable investing approach of, say, 2018 is no longer. Things have changed, and we're at this sort of titration point now in many of our approaches and strategies where what's worked for the last, say, 5 years is not, it has to change, and it's not going to be, status quo. So what that means is we need to probably remove ourselves from some of the conversations, the more polarized conversations, and get super focused on what is actually material to the portfolio. So that means avoiding a box ticking exercise and being able to showcase with our CIO office what is material to the portfolio and coming to them with sort of practical solutions and showcasing that our approach is really about what is decision useful for the investment teams. The other part of it is behavioral, and it may seem soft touch, but enough can't be said. And I actually just came from a lunch now where the individuals were discussing the importance around building those trusted relationships at myriad levels and making sure that we have that sort of relationship where we're being asked to come to the table.
Yes.
As opposed to, many of us who've been in this world and role for 20, 25 years where it's constantly pushing, rock up a hill. It's really nice to finally see that change where we're being invited to the table, and not just by, our internal investment teams, but again, using the private company models, being asked by them for more. So I would say focusing on the materiality aspect, showing like a real laser focus on what is practical for the investment teams, what's decision useful, and then again on the behavioral side of things, making sure that we have the right channels and the right messaging at the right time for people who are very much focused on many things. And so getting that message to them in the right way can be the most effective tool.
Yeah. Okay, fantastic. Bonnie, can I move down to you and ask you a little bit now, thinking about the sort of more the CIO conversation, the more internal conversation. So when you get that sort of tricky time and the questions are raised, and I mean, you're so emphatic that why are we even thinking about this? But it would be great to sort of see what do you need to, what evidence, what data, what do you need to do when you're having that conversation with the CIO to continue to have advocacy again?
Right. So the clients and prospects that we talk to aren't all as advanced as Anna and her team. Mm-hmm. So, it could really range from something like just talking through the misconceptions, some of which we've touched upon in this panel. ESG does not necessarily require exclusions. ESG doesn't necessarily mean equity ETF that is an index fund run against an MSCI ESG index that's a replica of the S&P 500 and is a sector tilt. It means more than that. And it's what we've been talking about during this conversation. It's understanding what is ESG investing, what is integration, and what are these factors that we're looking at that are financially material. And I think it does really help clients when they can see these studies that talk about performance. So within fixed income, there are a lot of actually pretty good studies, right? Because it's a totally different animal. It's very different from the equity universe. And there are generally two different approaches that we share with these clients to show them the data set around this. And one is around green bonds, and the other is just around ESG in general, ESG quality. Now, the problem with the green bonds is that most people will look at a green bond index and compare it to a non-green bond index. And that is not an accurate representation because it doesn't adjust for things like sector representation, duration, quality, all of those things. Not all sectors issue green bonds. So you absolutely can't do that. But what you can do, ideally what you should do, is look at an issuer that has a green bond and a non-green bond on the same curve. However, there aren't enough issuers that have that either, and especially not across sectors. So the other thing you can do, and what people are doing now, is look at the same sector, issuers that issue green bonds and issuers that don't. So they are in similar competitive spheres. And what you do see is that there is differentiation with positive for the green bond issuers versus the non-green bond issuers. Not always, however. So it has to be a differentiator competitively. So in industries like financials or utilities, because there's more issuance, it's a lot less of a differentiator. And if the governance isn't good, it is not a differentiator. So you're looking at these things in the aggregate. You have to be intelligent. And then, as I said, there's another approach, which is looking at issuers by ESG quality, but again, controlling for duration, spread duration, geography, maturity, all those things, sectored, if I didn't say that already. And so you have to look at that. And you also see there, higher rated ESG quality issuers do better. But in bonds, because it's all about avoiding the losers, it's really about avoiding the ESG laggards. And that's where you'll get the most outperformance. And so sharing those types of data points with the CIO and their offices is really helpful for moving this conversation forward.
Yeah, that makes a lot of sense. And Rob, I mean, you have to deal with long-short strategies. How do you even begin to think about it from a shorting perspective?
Well, I think that there's a continuum of information, and we try to use that continuum. And I think a lot of these concepts, there are going to be winners and they're going to be losers. And you want to go long the winners, and you have to be short the losers. And in climate, in social, in governance, I think that that's true for most factors. More than half, I would say, not all. So I think that the harder part is to get the regulators and the clients on board. The regulators have a hard time understanding how to put the short side of portfolios in the context of regulatory frameworks. Clients sometimes are no offense, are sometimes
sorry, we can have a bit of debate on the panel.
No,
that's fine.
no, but are sometimes clinging to these restriction lists where we don't want to own certain companies, and if you think it's a bad company and you want to short it, they say, well, we don't want that on our share register. But I think we run long, short ESG and climate specific strategies, and have had great luck. And this year in particular, our long, short strategies are doing fantastically, mostly on the short side. So, but you just have to make sure that you broaden your perspective to think about the winners and the losers.
And from as a investment manager, thinking now back to the communication and the conversation you've got to have with your clients. Am I right in thinking, did you have a client conference recently where you focused on this sort of thing? It would be interesting to hear how you start to convey some of these sort of nuances with your client base.
Yeah, yes, we had recently had a client conference where we had a panel very similar to this to talk about what are the alpha prospects for some of the ESG and climate strategies and concepts. So, and again, I think as Laura mentioned, it's not just financial performance, because I don't think we have a robust enough historical data set to make those relationships ironclad like we do. We have 100 years of financial statement data, tons of academics have poured over it, and you have a lot more confidence in what those relationships might be. I don't think we have that same level of confidence for ESG data. So that's where you have to go to other layers like financial materiality, and what's it doing to other metrics that may be indicators of future stock market performance, multiple expansions, profit margins. If you're looking at human capital, looking at employee turnover, there should be some correlation. If you're doing right by your employees, you should probably have less turnover. Yes. In terms of employees. So just more fundamentally based metrics to try to see, is this something where there's some efficacy in the signal?
Yeah. Is there anything, Arup, from a quant perspective you'd like to add in terms of, the importance of data here? And
Yeah, as I mentioned, backtesting or data mining, how we want to call it, is a tricky game, especially when you have a whole bunch of data providers, especially in the ESG area. And so you better be, I always have a rule in my team that whatever we are backtesting or trying out, you better have a very conceptual basis for it. But I've seen in my past, people I've worked with where you suddenly do a lot of back tests, kitchen sink approach, you find something that works, and then always find the rationale why it worked. But I've seen each of those factors in the future always fail. So my team knows that everything we tried out, specifically more in the ESG framework, where there's less data, as Rob mentioned, so there's good data, maybe 10, 15 years at most. You have to be even more careful here. I mean, just make sure that you're conceptually very strong, the tests are backing you up, and make sure they have buy-in. And so I would say that framework, especially in ESG research, to me is extremely important.
Okay, so
Can I
that's
add
sort
to
of
that really quickly?
Yes,
I
sure.
think that's a really important point, and I think there's a lot of risk to data mining in this space, given how noisy and heterogeneous the data is. And I do think that's really important. And one of the things that has worked has been this prospective view, and I think that's what's different about ESG than some other factors as well, right? You're looking at things that haven't necessarily happened, or having a prospective view of what are the risks on the horizon and how are companies managing those. And if you just selected those factors based on their historical performance, kind of absent the conceptual piece of it, I think a lot of this would fall apart.
See, if I may just add one.
Of course you can.
So I would say when I first did
Go ahead.
ESG research about 10 years back, looking back at that point, quants and backtests, G was the most dominant factor, the way we found it. This was done in 2015, 16, 17. The last few years, at least the way we do it, E is the dominant factor. And I won't be surprised if S is the dominant factor a few years from now. That's why I believe this is research which needs to be redone every couple of years as the world is evolving, the focus is changing. You need to be more updating your ESG process than any other process that may be part of your stock selection model.
Yeah. I think it's really naturally taking us onto this research question and the use of research, especially when it comes to fundamental analysis. And Bonnie, maybe, with now maybe the more multi-asset side of what Western does, it would be great to sort of get a sense from you as to, again, do you see the use of research, how it plays out differently for different asset classes, what you need to really focus on?
Right. So we cover all the different asset classes within fixed income. So there's a huge variety. There's corporates, there's sovereigns, there's bank loans, there's high yield and investment grade, there are emerging markets, CLOs, and MBS, ABS, structured products. And all of those are not necessarily covered by a third-party provider, right? So it is a very customized approach, proprietary approach that managers are going to have to take if they're going to cover all of these different asset classes. And for us, we definitely do that. We want to try and look at, again, what's financially material. Going back to picking up on what others were talking about here, when you look at returns and what's driving them within the asset class, not all of them are going to be driven to the same extent. And not all of them are priced as efficiently. That's really the challenge for us as investors. It's identifying the financial material factors, but then also finding out where they're mispriced. And there's definitely more opportunities in some of these asset classes than others. I totally agree that over time, we're going to see these shifts. The reason governance isn't as much of an opportunity is because it's pretty efficiently priced now. Social isn't yet, but it likely will be, especially with a lot of the recent developments that we've had. And eventually, yes, climate will be. We're definitely not seeing that, even though it's sort of ironic because we all know that all these conversations are about climate risk, and yet it's the least, the least well-priced, least pertinent when we look at these rating agencies.
Except for insurers this week are really taking a hit.
Except for insurance, yeah. And when we talk to them, they have the data, they see the dollars. And so they've got it. But the rest of the world is going to follow, especially as our own premiums go up, both personally and as businesses. So it'll just be very interesting to see how this evolves. But at the end of the day, yes, you have to be really, again, thoughtful about the asset class and financial materiality.
And Rob, if I can just bring you in as well, thinking about if you're doing where you run both using quant and fundamental, you combine the two pieces together. So if you're thinking about your starting base where you build a universe, a quant sort of database universe for the fundamental overlay,
right?
How important is obviously the research and the ESG rankings to help you in that process of creating that initial universe?
Yeah, so for the quant, as Arup said, breadth is the most important thing. So we want to try to have a model set that has good coverage with the underlying data units. for that strategy. I think when we're talking to discretionary managers, either on the equity or the credit side, it's really trying to understand what their process is, what's their universe, how do they think about the world, what are the key things that go into how they evaluate assets, and then part of our job, my team's job, is to figure out how does that play, what factors are relevant. So if you're running a global growth portfolio or consumer brand portfolio, chances are environmental factors aren't going to be a huge component of that. So like what are the key components facing some of the big growth or consumer brand companies, and then really work with them and work with the analysts to figure out where do they see the risks. And we say, hey, we have all of these factors from our quant models. Which ones do you think might be relevant for valuation or risk factors, and kind of go about it that way.
Yeah.
And even from a governance perspective, where they know the companies really well, we had an instance where there's a company where the board is 100% male, and they said, yeah, but these are the founders of the company and their sons, and trying to get that perspective of this powerful brand of the company that has this, that they just like, what's wrong with that? Of course, you want to have the key players on the board.
So back to research, Laura, I think sort of as our sort of research and ratings provider here on the panel, and we're talking about this, I'd just love to get your perspectives. How do you go about supporting these investors sitting here in their work?
Well, they all need different things, and we try to keep everyone happy. But I think it's important, and I think you guys are all very nice to me because I'm here. But there's a role for ratings, and there's a role for ratings. It's not everything, and a lot of our clients use a lot of different pieces. So ratings for me are a starting point for a lot of our clients, for more fundamental clients. It might be a way to filter a very large universe and figure out where to focus. It might just be the first thing you look at and you say, okay, I disagree with this, I agree with that, and I'm going to move forward with my analysis. For a quant, the rating might be just the top of the iceberg, and you chop that off and go underneath it and look at the hundreds and sometimes thousands of subscores that underlie that and build your own models. A lot of our more sophisticated clients will build their own models with our ratings, and so our goal is to have that be a starting point and a benchmark, because it is one common language across the ecosystem, whether you're talking to asset owners or you're talking to asset managers or you're talking to companies, portfolio companies. Increasingly, I think we have tens of thousands, maybe hundreds of thousands of engagements with companies a year who are trying to understand their own ratings because they're being engaged on those ratings by investors. So it's a common starting place, a common benchmark. And if what you're trying to do is beat that benchmark, we also can give you the tools and the data to support that. But I think something that's also really important is that measurement matters, and that in a space that's this noisy, it's interesting. There's a lot of magical thinking sometimes in this world, and it drives me a little nuts. But also, I think there's some unfair criticisms that are hurled, and I've seen so many times where someone looks at ratings from one provider and then they kind of generalize about the whole industry or the whole ESG effort. And I think when we do see still not that much correlation between different ratings of different agencies, which to me is a feature, not a bug. I think having diversity is good. You also see them behave very differently. So for example, a study by MIT earlier this year found statistically significant alpha in our ratings in Japan, US, and Europe, and not in other providers. And maybe some providers perform better in some markets in certain conditions and others, and maybe some of your custom strategies do better than all of them and all of the above. But I think it's important to get kind of beneath the surface and start to understand this in a more nuanced way, and the ratings are there to use as a tool, but they're not there to just blindly rely on.
If I could just say really quickly, those types of issuers where you see that variance in the ratings, those are actually the most interesting to us, because where that disagreement is potentially opportunity. That's where you see different pricing, different perceptions of the value. We actually like that.
Yeah.
So
I was also going to add that I couldn't agree more, and there's such a tendency towards sort of or a preference towards absolutism and thinking around this. People are always wanting sort of that answer nicely tied up or like put in a box, and for some reason the criticism is always sort of like, well, which one is it? Is it black or is it white? And it's not that. It's far more complicated, and I think the opportunity is in the discrepancies and the differences, and that's where we can bring in our own in-house internal experts and align it with our respective investment approaches and differentiate that way, as opposed to having sort of this silver bullet, one size fits all. Yeah.
If I may add,
course,
so I would say I think of this whole ratings debate about how MSCI is different from this and that. To me, just like Laura said, I think that's an opportunity. Because to me, we both were the same firm in 2007, and there was a lot of talk about quant alpha being all similar to each other. I'd rather be today where I worry less about quant alpha being similar to each other because there's so much more diversity of opinion. NLP, machine learning, has made the world so much more diffuse, diverse, and so different quants hopefully can add alpha at different points. I would say the same case for ratings. I mean, why are we so fixated on why those ratings are different? Use that as an opportunity to build your own better model.
Here, here.
Okay. So not all ratings and no agencies, they're not all made equal.
Yeah.
All right. So now this is a bit, I'm going to get you to give the audience some takeaways from all of this conversation around, ideas, themes for generating alpha from sustainability going forward. So I'd love to hear from each of you your sort of top themes, top suggestions, advice. So maybe Arup, starting with you.
I mean, I'm not in the forecasting business, but I'll try to make a forecast here. Just like I've seen the G, maybe being priced away to some degree and E being more dominant, I would like to see S being more dominant in the future. I mean, that's how I build my own team. I like diversity. I like a lot of different views coming in. You'd like to think that should be helpful to all companies to have a more diverse mix. I'd like to also think, as I said, in our firm, there is the engagement part, and then there is the stock selection part. I'd say we ourselves should do a better job of how the two are married to each other. Even though, as I said, the engagement team does their job well, we do our job well, we should have that feedback loop going forward. And then, where they're engaging and they're not finding the right answers, that should perhaps have a feedback loop into my quant stock selection model. The only problem with that approach is you won't be able to do that across 20,000 stocks, but you may be able to do it across fewer stocks, but that will make you a better investor.
So it's that real question around integrating, the results from engagement back not just into the fundamental research work, but actually back into the quant side of things. Okay, that's really interesting. Rob?
A couple themes that we're working on. One is just real world decarbonization, specifically in public markets. I think when you're dealing in privates, it's a lot easier to think about decarbonization, but how to measure decarbonization, for say public equities or public credit, I think is a key component. Things like avoided emissions and, climate solutions versus changes in climate adaptation are difficult questions, and the data to support those decisions is really scarce, and trying to incorporate those. So I think that's a big opportunity, because if we really want to solve climate change as a problem, we've got to focus on heavy emitting industries and not just having low carbon portfolios. That's easy. We can do that in our sleep. So let's focus on heavy emitting industries that can really transform their processes.
So looking to make money from the process of transition, so potentially staying engaged and invested but choosing the companies that have the right transition plans,
right,
and then riding it with them and engaging and helping them on that journey versus just divesting and moving into something else and leaving someone else to own it. Really taking the opportunity as well as managing the risks.
Yeah, and I would say water is another one. I mean, I think water scarcity and water efficiency affects a lot more companies than most people think, and everything from shipping to agriculture to semiconductors, and thinking about the implications of water scarcity, water pricing. I think there's a big opportunity there.
Yeah. And what about the climate funds, the actual climate opportunity investments as well? There's funds out there that are wholly focused around innovative technology, for instance, to provide the solutions for the future.
Yeah, I mean, I think we have. I wouldn't say that that's kind of a new focus, because that's something we're already doing, of trying to use what those new, transition technologies are, and trying to find companies that are exposed to those very specific. There are like 550, where the IEA says there are 550 different technologies that apply to decarbonization. So figuring out which companies are involved in those, I think, is a key part of this decarbonization. So
Exactly. So it's all linked into that decarbonization theme. Okay, excellent.
This was not planned, but yes, perfect segue, and can piggyback onto what Rob was saying. But look, we very much at Teachers believe that the transition to a low carbon economy presents a generational investment opportunity. To overhaul the energy system is going to take trillions and trillions of dollars. And so what we were talking about before is like there is very much a paradigm shift happening right now. And so the concepts and thinking and possibly antiquated thinking around what is alpha is going to change and is changing. And so while we have this incredibly important and current focus as an industry on reduction of portfolio carbon emissions as the measure, I think what we're going to start seeing, and based on the conversations many of us have had as early as yesterday morning, what we're going to start seeing is this evolution in approach to really start looking at value creation and how can we better work with higher emitting companies to further the transition faster.
And can I ask, are you doing that? Have you got a geographic focus? I mean, has this got the emerging market lens? I mean, there's a huge drive to mobilize capital to emerging markets for exactly this purpose, to help them transition.
Yeah, at Teachers, we don't have an enormous focus on emerging markets, but our investments are globally focused.
Okay.
Okay, really good points, and I agree with all of them. It's not necessarily going to be what happened historically. I think it's going to change, and so maybe a couple thematic points and then a general one. Transition for sure. I think we're doing a lot of work ourselves with our research team, our sector research teams, as well as our quant research teams on winners and losers within sector in a transition. So not just lower emitters, but what are the companies that are transitioning faster, that are better managed, better positioned. I think that's going to be a really big one. But then also, what are the big disruptions coming up for companies and how are they managing those? And so this is maybe not a 5-year horizon, never mind, it's probably a 5-year horizon, but how is AI going to disrupt workforces? What are the big shifts and transformations that are going to be affecting companies, and how are they gearing up for those? So AI is a big theme. We're trying to get our arms around it and all the different dimensions of it, but there are others as well. So I do think that social pillar reemerges as something interesting. I guess a third part is just, we're not in the business of generating alpha. That's not what we get paid to do. But we encourage you all to do so. We benefit when you do. So, we see the telemetry, right, of what's being used. Our ratings are being used. I'm not going to say use our ratings, tilt on that, ignore the rest of the world, and you'll win. But I think there's a lot of richness of data, of information. That information itself is expanding with AI and the ability to kind of process qualitative information. There's a ton of disclosures that are coming out of companies. A lot of it is very, very noisy. But for all the quants in the room or the people who sit next to quant teams, there's a lot of information. We can give you a lot of it. Our peers can as well. Really kind of kick the tires on it. I'm really encouraged by the fact that this room is full, because there was a feeling a couple years ago that we were done with this conversation, and I felt like that was premature, and I'm actually glad we're having it.
Yeah, fantastic. And sorry, Laura, just from an index provider perspective of MSCI, I mean, there's a role there as well, right, for the construction of the right indices in the right way that's ultimately going to help in driving absolute return, not talking relative here, not talking alpha, but the absolute return that can come from that right construct as well, right? So that's a really important role that you have to play in this.
Yeah, and also, the way that we construct indexes, we have our standard indexes, but a lot of it is very client-led. So it's about what are the objectives, what are you trying to achieve over what time horizon, and can we use data in a systematic way and research to do that for you, or do you want to do it yourself? And, those are two options.
And Bonnie.
Yeah, I mean, a little bit of the same, but also a little variant on it. We started this conversation off talking about factors, and I think climate transition readiness is itself a factor that is not being used, as we were saying, not being priced by the market. It's not really an E factor alone. It's really a combination of all three of the pillars, right? And it's not something that can be easily measured. There's certainly, and we have help from MSCI and other providers with data points, but we have indices that are trying to identify this, but it's really not perfect and it's really not being priced correctly. And I think that is going to be a huge opportunity. When you look at carbon markets, 99% of them are below the price that you need to be well below 2 degrees. So there could be a really rude awakening when we see these step changes. And I think some companies are getting wise to that. They may or may not be rewarded for it, but being able to identify those that are more prepared or those that are providing climate solutions to help others be prepared for it is going to be a huge opportunity both in the public and the private markets.
Fantastic. There's some really good ideas in all of that. We're going to move ourselves across to the Q&A. And we've got quite a few questions in. I'm not sure whether the tech friends at the back are able to put them on the screens for the panelists to see, but if not, I'm going to start with the first one. Arup, the first question, which has the most likes, is directed specifically at you, so I'm going to read this one out to you. When you mention ESG factors and have added value everywhere, what do you mean by ESG? Are you referring to a top-level aggregate rating or specific ESG factors? And if so, which ones have shown the most promise?
So we build our ESG factors. Version 1 was by industry, and it varies by region. So what we use in China may be different from what we use in the US for sure. For example, you look at competitive behavior as one issue in Europe, does not work elsewhere, things like that, which makes sense to me. So therefore, it's not a one-size-fits-all, but we're looking at E, S, and G, all of those three metrics together in terms of what, they have to be very material. I've heard that term used many times here, SASB material otherwise. And then, so when I say ESG factor has worked, what I mean here is we have a final ESG score. And when we look at our top decile performance, sector region relative, which is how you need to look at it, because that's how we pick stocks, it's added alpha everywhere. Okay. But if you're asking me, are the 13 components of ESG in China versus the 11 in US large cap, have each of them added value? Perhaps not each of them, but the overall mix of how we have put together have added value. And that's what I ultimately care about, is the overall view on ESG, of what we believe about that company's ESG practice. And if you believe they're the better one than their peers, even if they're in a dirty integrated oil space, has that played out in the markets?
Anna, we've got a question for you. It says in the last couple of years, you've said that you've become much more engaged with your managers. When that's when we were giving the context around some of the underperformance in the markets. And the question is that because you were worried that they were starting to give up on ESG and sustainability, or was it really just to ensure that they were doing what it says on the tin, as you said?
Yes, and thank you, Henrik, for the question. I'd say no, it wasn't because, sorry, this microphone continues to fall off my ear here. It wasn't because we saw them as starting to give up. If nothing else, actually, we started to get invited to the table more. So we are very lucky to have quite a sophisticated team that's been built over the last number of years. And with that, and when we're talking about managers right now I'm talking specifically about our investment managers. So over the last number of years, we've built very good relationships and inroads with the different asset classes. And so we actually work hand in hand with them as partnerships and co-creators of their approach. So we work with them everywhere, beginning from the due diligence phase, as I mentioned before, across the asset life cycle. Of course, oftentimes more time is spent with some of the asset classes. For example, natural resources or infrastructure, for example, would be a group that we'd spend a bunch of time with. But no, the last 2 years and what's happened in the market hasn't been something that's pulled people away. If nothing else, it's like, okay, what does this mean? And from what we're seeing globally in terms of climate effects, what does this look like in terms of physical and transition risk?
Thank you. So a question around time horizons. Isn't the alpha challenge linked to the tension around time horizons and then idiosyncratic issues versus systemic risk issues. Be good to get a sense, Rob.
Yeah. So I think time horizons is a key question. And I think like when we talk to different investment managers within Man, part of it is what's the time horizon of your strategy versus the time horizon of the signal that you're trying to use. I think that's a key component. And you want those things to be linked as much as possible. If you're looking at a physical risk climate model, where you're looking at 5 or 10 years out and it's a short-term trading strategy, there's an inherent mismatch, and that's probably not a good signal for that type of strategy. But trying to use things, because some of the ESG concepts are longer tailed in terms of time, trying to come up with other ways to try to measure shorter term components of that. So looking at, climate news, a lot of news on Hurricane Milton right now, and what are the implications and which companies are being mentioned most frequently for that, or, scraping Glassdoor, or there's some Japanese and Korean, employee website rating agencies using that as a shorter term way to measure the effectiveness of a company's human capital. So I think that there are some things that you can do to try to synchronize the time horizon of the strategy and try to make ESG as a concept a little bit more dynamic than the once a year updating and kind of slower nature of the inherent signal.
Yeah.
Just to add to that real quick, one of the major challenges I think with recognizing E was this and has been this mismatch in time horizons. As well as just in public markets, especially, issuers that are publicly traded, they live on a 3-month clock. They really are just trying to beat 3-month performance. And, all those things together have made it a challenge. Unfortunately, with the pace of climate change accelerating, I think you're seeing a lot less of that. Certainly, it's more marked in, again, sectors where it's more financially material, whether that's home builders or, anything that has more physical risk. It is definitely being considered a lot more strongly than it would have been even just 5 years ago. So there's less of a mismatch there, but clearly a lot more room to go on that. For us at Western, our analysts are generally taking a 3-year outlook. So for a sector that's less exposed to physical risk, like a bank or something, that's going to take a little bit more creative thinking around how much do we want to weight something like this. And we know the banks are going through their own transformation where these types of risks aren't being priced into their valuations, but the expectation because of regulations is falling upon them. So that's helping as well. But the efficiency in the market isn't there when you look at the mismatch between the time horizon of some of these risks and how most investors look at them in many sectors.
If I may just add, so time horizon is important, and that's why, in my view, you need to build it yourself. You know how your process is, what's the time horizon you're playing at. So whatever you're adding to your process needs to be effective in that time horizon. Mm-hmm. So obviously, if you're a startup or high frequency, I don't think these things play a role. Mm-hmm. But if you're more in our time frame, which is 6 months to 18 months, many of these play out well.
So the question that's got the most likes against it, it's probably the hardest to answer because I think there's a lot of caveats or lots of different aspects to it. So in terms of numbers, can you give us some insight as to actually how much alpha has been generated from ESG? Now, clearly it's going to depend, are we talking over a 1 year, 2 year, 3 year time horizon? What's the attribution? What's the benchmark? What's the fund? But I mean, if any of you've got a sense of anything here you could pick out.
So all I'll say is whoever's asked the question, please reach out. I was happy to share 1 or 2 slides, but no one else wanted to share it. And so that had the numbers. I don't remember it, but whoever asked this, please reach out to Mackenzie and we'll respond to you as to how it's played out for us on a monthly top decile outperformance versus its peers.
Yeah.
I think also, Rose, if I might select one of these questions
for the
panel, I just think it's so topical, and I'd be very interested to hear from everyone on Bo Wang's, if I see that properly, Bo Wang's question there.
So Bo Wang's question, let me read this one out. Decarbonization requirements are distorting portfolio construction. Should financial materiality-driven investors care about portfolio emissions?
No.
Did everyone get that quote? That was Rob.
Sorry.
I think it's such a good question. Again, I don't think it's a black and white answer. I do think when we say care, I think it's a very important measure. And at the end of it, we do have to have some types of measurements to have common understanding of where we are and where we're going. So important measure. Should it be the sole measure? Likely not, right? We want to look at what other measures we should be focusing on at a time of rapid change, right? Everything is evolving so quickly right now that I don't know how beneficial it is for us to box ourselves into one sole measure. I think we need to be very much respectful of the challenge ahead and understand that we'll be wanting to look at a suite of factors as it relates to alpha.
Yeah, I was being a little glib just because I was taking
it's good.
I was thinking decarbonization as kind of a pure portfolio level decarbonization, which I think is a very narrow-minded view of decarbonization. I think you have to really think about decarbonization potential, where you're thinking of heavy emitting industries and what's their potential to decarbonize. That I think is critical, but like anything, you have to put it in the context of everything else that goes into your evaluation of those assets. But I think that should be one of the main goals is this real world decarbonization.
Yeah.
Yes.
Yeah, and the
great.
reality
If I
is
may-
a lot of clients do have these net zero commitments. So we
Yes.
do work with them. And typically, we know those targets are over time. So it is about the decarbonization. I think where it's less useful and useful to the world is where we just want to get our portfolio emissions down on day one and just not have to think about it like a low carbon portfolio. As Rob said, that's easy.
But I do think it's important to separate between kind of policy goals like a decarbonization target, which I'm not going to say you should or shouldn't have one, that's up to you as an institution, versus the financial materiality goals. And those might be complementary, but they're separate.
So I think customization is the name of the game. So
Yeah.
whenever any client comes to us and says, we want this additional metrics to be looked at, as a quant manager, we always tell you what the effects would have been over the last 20 years. And usually from our perspective, so far, whichever client has come to us with these kinds of extra constraints, we haven't seen it take away alpha from our process. And we share that with our clients, and that's how we go with it.
Okay, I have a red light flashing at me. We have zeros across the board. I think it's time is up. So it sounds like if I'm going to take one theme from all of this, so I'm going to take two themes. One is ESG a factor? It's not the factor, it's one of the many factors. If there's a trend, it sounds like the trend is ensuring you remain invested and engaged in the decarbonization and in transition to a low carbon economy. And that's a way to manage your risks and also generate alpha and returns. And yes, and AI can be transformative as well. And we should be looking at that as an opportunity. So I'm just going to conclude the session by thanking our panelists very much today for such a fantastic session. Thank you.